So we are seeing the chart move down, which means that gold is outperforming the stock market. And because we're below the moving average, below the Ichimoku cloud, below the support line, just as we were on those previous three signals, historically, this chart is telling us that we're entering a precious metals bull era and a stock market lost decade.
Okay, guys, so today we have Kevin Wadsworth. I'm very excited because we're going to discuss what's happening with the economy right now. We'll talk about commodities, we'll talk about technical analysis, and a lot of other very interesting topics. So Kevin, thank you so much for being here.
Vladyslav, it's great to be here talking to you. Thanks for inviting me here. It's always a pleasure to talk about what's going on in the world of finance and economics, especially when I can share a few charts as well.
Thank you very much, Kevin. So I would like to begin by talking about the overall economy. So what's your take, Kevin, on what's happened right now and what are charts telling us?
Yeah, sure. Well, I've just sent a screen sharing request through to you, so hopefully I'll be able to share my charts in a moment. But just to summarize what the charts are saying, and there have been for a while, is that we've got a problem. We've got a lot of problems in the background as far as the economy is concerned, and they've been brewing like a gathering storm for 2 or 3 years now. I'll share my chart, and perhaps that might help to put it into some kind of context for people who are watching this. So you should be now seeing the 10-year yield chart. This is the
Yes.
US 10-year yield. And so when I said that the problem started at least a couple of years ago, 2 or 3 years ago, this chart really lies at the heart of that. And this chart lies at the heart of the problems that we're about to experience. You can see that the US 10-year yield, well, if we go all the way back to the beginning of this chart, it was 100 years ago. And we saw leading up to World War II in the interwar period that the 10-year yield was falling. Then it broke out and it went into a period from about 1950 to 1980 for 30 years where the bond yields were rising. Okay, so that's rising bond yields, which is a bear market for bonds. Now, during this period, the GDP in the United States, the gross domestic product, was falling from 70% in the post-war years to around about 31% in 1980. So the fact that, sorry, not GDP, I beg your pardon, debt to GDP was falling. So the ratio of debt to GDP was dropping. And what that meant was that interest rate policy could be used to tackle rising inflation, because as we know, inflation was rising from 3 to 5 to 7, 9, 10, 12, 15%. So inflation was rising very rapidly and in danger of spiraling into a hyperinflationary event. But eventually, monetary policy and the mathematics of it all balanced out. And by raising rates and using other policy tools, it was possible to control the rapidly rising inflation and bond yields. And so a downtrend began that lasted for 40 years. And it was essential that monetary policy was easing and that monetary policy was, how can I put it? So during this period from 1980 to sort of 2022, the debt to GDP was rising. So, it was a period where the money printers were working at full pelt. Whenever there's a problem, create some more zeros and add some more debt to the debt pile. So the debt pile measured in trillions rose from 5 to 10 to 15 to 20 to 25 and $30 trillion. As those numbers rose, unfortunately, so did debt to GDP from 31% to 129%. So in order to have a situation where it's possible to pay the interest rate on your debt, and that's what this 10-year yield is, it's the interest rate on your debt. In order to do that, rates had to be low so that the interest payments were low. And that was managed until the COVID pandemic. And we had this enormous downward spike where inflation and rates and everything else plummeted through the floor close to zero. And you might remember oil was trading in negative territory. They literally couldn't give it away. That clearly was a situation that wasn't going to last very long because um, in the world that we live today, then clearly there is going to be a resurgence of demand for commodities and for debt and for all the rest of it. So this was a technical signal, a breakdown from a wedge pattern. It was a technical signal that there was going to be a rapid upside reversal. And we posted about that on X at the time, and we said that it was highly likely that a rapid upside reversal and a breakout was going to take place. Now, if you cast your minds back to when rates were below 1%, I think the idea of having rates at 5% seemed crazy. But sure enough, the rates rocketed skywards and hit 5%, and they've been consolidating just below that level for a while now. This is a technical breakout and consolidation, which is bad news because policymakers want this to come back down to, let's say, 1 or 2%. And from a technical point of view, given the debt dynamics, I think that's highly unlikely because if you reduce rates down to that sort of level, you're going to stoke inflation. And that is the very last thing that you want when you've got debt to GDP north of 120%. So we've got a catch-22 position here where the traditional idea, and there's a lot of pressure on Powell at the moment to reduce rates, and Trump keeps attacking him personally, which I think is terrible. And he's basically Donald Trump is giving the impression anyway that he doesn't want the Fed to be independent. He wants the interest rate policy to be determined by the President of the United States, which opens it up to political um, um, interference, if you like, and dropping rates down to 0% just before an election, for example, regardless of what the economy is doing, would be one way of collapsing the economy completely, because the whole point of the Fed being independent is that it makes unpopular decisions, and the Fed can see what I can see. Powell, for all of his errors and mistakes and accusations of being late, can see what I can see, and that is that he's needing to control the problem that is developing, and dropping rates at the moment and encouraging and bringing back inflation into this sort of environment is going to be suicidal for the economy. Um, so that chart lies at the heart of the issues. Um, if we were to look at, for example, the gold price, the gold price has been sending a signal for quite a long time now, ever since it broke out above $2,000. And the speed at which it went from 2,000 to 3,500 was breathtaking. And, it seems to have gone by largely unnoticed by a lot of investors that gold has gone up by, well, it started down here at $1,600. So gold has more than doubled. And a lot of economists seem to be not taking a lot of notice of this, but because it's done that, gold has sent another large warning signal to the markets. And what I mean by that is that priced in gold, the stock market, the Nasdaq, the Dow Jones, the S&P 500, they're in bear markets. They've moved into bear market territory, and so that very fact has only really happened three times in the last 100 years. It happened in the around 1930, around 1970, 71, and around about the year 2000. And those dates, any economist should be sitting up and taking notice, because those dates were the beginnings of a very nasty period for the stock markets, where it took more than 10 years for the stock market to get back to its previous highs. So if we're saying the stock market is peaking around about 6,400 on the S&P now, it means that we could be 10 years from now before we get to those sort of levels and break above them and move into a new bull market for the S&P. So that's the backdrop to the problems that are going on at the moment. And as I said, the stock market's broken down versus gold, and this is the proof of that. It's the Dow to gold ratio. Sorry, the Dow to gold ratio. So when the ratio is going up, the Dow is winning, and when the ratio is going down, you're in a precious metals bull era where gold uh, doubles, and then it doubles again, and then it doubles again, and then it doubles again. So, gold goes up by many, many hundreds of percent whilst the stock market goes nowhere. So you had a signal there when it broke down and we went into a gold bull era. And that happened around about 1929, 1930. The second signal when we broke down, and when I say breakdown, what I mean is we break below the support line, break below the moving average, and you break below this red and green splodge here, which is called the Ichimoku cloud. It provides support and resistance. It's a technical. You need to be above it to be in a bull market, and you need to be below it to be in a bear market. So you can see this chart is in a bear market once it breaks below, and we're below the moving average. That's the 8-year moving average. We're below the um, inclining support line, and we're below the Ichimoku cloud. So at that point, we broke down into a bear market for US stocks and a massive bull market for gold. And then we entered a period of reversal with bull market with the stock market in a bullish phase and gold in a bearish phase. And then, broadly speaking, for the entirety of this century, gold has been in a bull market with a pause from sort of 2011 to around about 2018 or so. But the valuation of gold to the stock market is still, I'll put it the other way around, the stock market is still hasn't regained its valuation that it had versus gold 25 years ago. So this could be viewed as one massive bull market for gold versus stocks. You can see how it dropped in a bull market, then it bounced upwards in a bear market rally, and now we're breaking down again. So we are seeing the chart move down, which means that gold is outperforming the stock market. And because we're below the moving average, below the Ichimoku cloud, below the support line, just as we were on those previous three signals, historically, this chart is telling us that we're entering a precious metals bull era and a stock market lost decade. So yeah, that's where we're at. That's the economy as it stands at the moment, Vladislav.
Yes, that's very interesting, Kevin. I'm myself a big fan of the ratio charts because, as you're showing it here, you can visually see what's happening and you can compare two assets against each other and have a very good idea of how they're doing, well, against each other, but even independently if they're in the bull market or a bear market. So yeah, it's very interesting. Gold looks, because if you think about it logically, gold performed really, really well. And of course, sure, it looks like we could have a pullback. But for the long term, even from the technical perspective, from the fundamental perspective, the structure of the monetary system, the deglobalization, things look still very, very bullish for the precious metals and commodities overall.
They do, yeah. I'll share my screen again. We'll take a slightly closer look at gold, and if I just zoom in a little bit onto the 8-hour chart for gold, and this is something that people watching who might be fairly new to technical chart analysis need to understand. You can be bullish and bearish at the same time. You can be, just let that sink in for a moment. You can be bullish and bearish at the same time. What I mean by that is you can be bearish for the short term. In other words, you're expecting the price to drop or pull back or fall lower. But in the long term, you're aware that you're in a bull market. So this is an example of that. Gold is broken down and this is an 8-hour chart. What that means is if I put candles on, each one of these candles represents 8 hours of price action. So the chart only goes back to April of this year. All of these 8-hour candles, they take us back, well, if I go all the way to the left of the chart, early April. Okay, so I'll put it back on the line chart. So we broke down, and here we started to turn short-term bearish. Okay, the price dropped from 3,340 down to 3,270. Now it remains bearish in the short term until or unless the price breaks above these two red lines here. and that was the point at which we would turn bullish again and start saying it's looking like gold is going to move significantly higher. So for the time being, until it breaks out there, we remain bearish. But when you zoom out and you look at the big picture for gold, it's a massive bull market. When gold broke out back in the back end of well, it was around about December time, I think, of December, January of this year, December last year, January this year. When it broke out, I drew this dotted line on the chart saying that it would make sense if we move up to around about $3,600, 3,500, and then see a pullback. Don't know how big, but some kind of pullback, might even test support before the bull market resumes. And I'm expecting the final bull market destination to be somewhere between $8,000 and $12,000. So we're massively bullish in the long term, but in the short term, aware of the fact that a pullback is entirely possible, maybe even probable, because of what I just explained about the stock market. And a lot of other indicators are now flashing warning signs. I can explain a little bit more about that by taking a look at the yield curve chart. This is the 10-year yield minus the 2-year yield. So it's the yield curve inversion. Basically, what happens is from time to time, the 10-year yield minus the 2-year yield, this is bond yields, goes negative. And then it always moves back into positive territory after a relatively short period of time. So usually the 10-year yield is more than the 2-year yield. So when you subtract the 2-year yield from the 10-year yield, you get a positive number. So therefore the chart is usually in positive territory. But occasionally that gets inverted and you get an inverted yield curve. And that's when we're below this red zero line. Now, that's what happened recently. And you can see a very, very deep inversion and very long in terms of time from what's that, June of 2022 through to August of 2024. So more than 2 years, the yield curve was inverted. Now, what happens when that situation reverses and moves back above the zero line is this. I'll just put the recession indicator on the chart for you. So those vertical green stripes are recessions. So we had one after this inversion. We didn't get a recession here because it was barely inverted, but we did have the Asian crisis. Then we had a recession following this inversion and the dot-com bust. We had a recession after this inversion and the great financial crisis, subprime catastrophe. And after this interaction with the zero line, we had a very small recession and liquidity crisis and COVID. Purely coincidental in terms of COVID, I would say. But what I'm getting at here is that there's always some kind of market calamity and recession, high recession risk when the yield curve's been inverted. So this is one indicator amongst many that something nasty is likely to be heading our way. So a couple of years ago, when I started producing this chart, I said that plausible deniability and distraction are coming, and all of this stuff around Powell, the chairman of the Federal Reserve, that's all part of this plausible deniability and distraction, because obviously they're going to want to lay the blame at his door, where in fact he's actually doing the right thing, because by reducing rates, it's going to cause a much, much deeper catastrophe, and keeping rates restrictive and probably raising rates is the way to go. If the political pressure is such that he reduces rates, or he gets, let's say, he gets fired and someone gets put in his place that reduces rates, then what do you think happened in the year 2000 and the year 2007, 2008, when we started a rate cutting cycle? Well, you can see what happened. The stock markets plummeted and we had a recession. So reducing rates for all the wrong reasons, and believe me, managing your pile of debt because it's too big is a wrong reason, a very wrong reason to be reducing rates. Or we owe too much money, so we have to print money, we have to throw money at it to solve the problem. Well, no, that's not how you cure a disease, by exposing yourself to more disease. You just hasten the death of the patient. So we've got a big problem here, and that is just one of the charts that is telling us that we've got a big problem. Another one that is telling us we've got a big problem is this one. It's the interbank lending rate, which has a high correlation when it drops sharply with recessions. Now, I'm not an economist. I have no idea why this is the case. And discussing this with others a day or two ago, it was pointed out to me that the environment that we find ourselves in now is very, very different to any of these previous environments. And that's completely true. In the 1970s, when to the left of this chart doesn't go back as far as the 1970s, but in the 1970s, we had different debt dynamics. In the early 2000s, we had different debt dynamics. The 10-year yield hadn't broken out, but I'm not entirely sure that. How can I put another way of putting this? The mixture of conditions that created the problems in the 1930 stock market collapse, the 1970 to 80 stock market lost decade, and the year 2000 to 2012 lost decade for stocks and stock market crashes. The mixture of ingredients that created those, it's like a melting pot of bad choices, and each one of these occasions, when it all goes wrong, it's going wrong because we're getting a combination of all of these bad options. You know, you get yourself into a situation geopolitically, economically, where there's no way out. And it's my belief that it's the mathematics of all of this that is driving the issues. And bad maths, when the math ain't mathing, is unavoidable. And that's why you get these kind of this sort of cyclical behavior that takes place. So to sum it all up, what I'm saying is we've got a massive problem. Mathematically speaking, the sums don't add up. Geopolitically speaking, it's an absolute nightmare. We've just had the jobs numbers released as well, and I just remind myself what I put on my social media. Here we are. So that's the post I just put out. So the statistics that have just come out, the reported numbers, were estimated to be 104,000 jobs added, and instead of that, it was 73,000. That's a massive, massive miss on the US jobs numbers. And even worse than that, much worse than that, is that May was revised down from 125,000 jobs added. So revised down, sorry, I beg your pardon, get this right, revised down by 125,000 to just 19,000. The June numbers were revised down by 133,000. So the original number that was given out was 147,000 jobs added. That was wrong. It was just 14,000. So by that measuring stick, this 73,000 could very well be revised down to a negative number next month. That would mean the US is hemorrhaging jobs and, well, recession, anybody? These sorts of numbers and the charts that I've just shown you are an absolute catastrophe for the United States economy. And just one other thing to mention, I've had this pinned to my feed on X for, well, actually it predates October, because I originally posted this. It got 1 million views, and then suddenly it disappeared off my feed. I don't know what happened, but it just disappeared without trace. The whole post disappeared. So I reposted it after about a few months of it being on there. So I put it back on there in October of last year. And this is the capital rotation process that's taking place. Capital rotation, Vladislav, this is how we define it at NorthstarBadcharts. It's a rotation away from stock markets and risk on assets, if you like. Cryptocurrencies are included in that, to precious metals, principally gold and silver in the first instance. primarily we're measuring it with gold. So it's a rotation. It doesn't mean all the money comes out of the stock markets and goes directly into gold. What it means is that the relative performance of gold and the stock market shift in such a way that gold is in a bull market versus the stock market. So that's capital rotation. And the evidence for that comes from a number of sources. And another point about technical analysis is that it gets a bad name because it's often done badly. You know, somebody will put out a piece of technical analysis and they'll be focusing on one piece of evidence, one chart, and they'll draw a conclusion from that one chart without looking at all of the weight of evidence around it. And then their one chart doesn't work out because the weight of evidence that they didn't look at would have told them that it's unlikely to work out. And then therefore their technical analysis that they've done adds to the pile of technical analysis that gets a bad name. What people need to understand is that TA isn't a magic bullet. There's no magical answer to what will happen with the price of gold or what will happen with the S&P, but simpletons on social media seem to want black and white answers. Will the S&P go to 10,000? Will gold go to 3,000? It's not a will or won't black or white situation. It's a case of weighing up the probabilities. And when you get a situation where the probabilities are strongly stacked in one particular direction, that's when you take action. So if I can say with confidence, a high degree of confidence, that gold is going to pull back, then you can take action, or I can take action anyway. What other people do is up to them. And if I can say with a high degree of confidence that gold is going to, or has broken out and is now in a new uptrend, then that's when you take action from a trading, investing point of view. So back to this chart, it's all about weight of evidence. If we're saying that capital rotation is taking place away from stock markets towards gold, we need supporting evidence. So what happened in 1930, the early 1970s and the early 2000s? That's a question. What happened? What else was going on that we can look at today and see if it's going on now to support the idea that those big events that happened previously are likely to be repeated now. And so these are a few of them, a few of the key ones. So US money supply is now in a bear market versus gold. The US dollar index, so that represents the strength of the US dollar versus a basket of other currencies. When the strength of the US dollar versus those other currencies cannot outperform gold, then that indicates a precious metals bull era, just like the previous red box did. So DXY is now in a bear market versus gold. Consumer prices are in a bear market versus gold. In other words, gold has broken out versus CPI. And producer prices are also in a bear market versus gold. Gold has broken out versus producer prices. All of those four things happened on those three previous occasions. Currency in circulation is in a bear market versus gold. The equal weighted S&P, if all of the stocks in the S&P had an equal weighting, that's in a bear market versus gold. The New York Composite Index, the Dow Jones, the Wilshire 5000, the Russell 2000, they are all, so in other words, the stock markets indices are in a bear market versus gold. The S&P is in the process of well, it sort of kind of has broken down into a bear market versus gold, but it's not quite convincing enough yet to turn this box red. And the Nasdaq equally is breaking down versus gold, and this box is pending, turning red. So the missing piece of this jigsaw puzzle to be able to, and you can only really say that capital rotation event has taken place with hindsight. It's very difficult to do it in real time. We're doing the best that we can by using all this weight of evidence, but it's very clear in hindsight, a few months after the event has occurred, but at the moment it's a capital rotation process. The event will occur when the S&P, the stock market, breaks down versus gold. So the missing piece of the jigsaw puzzle is the stock market. It needs to do something quite nasty to confirm all of this. And the S&P 500, as you can see, has two options, or at least I was saying it would likely have two options, either to follow the green path and melt up before breaking down, or to just reverse here, because we're on an important resistance line here. So either we're going to sort of consolidate here for a while and break out, follow the green line, or we're going to start tracking downwards in another large downside move that would probably test the level at around about 5,500, that sort of area, 5,600. So 1,000, well, about 750 points below where we are now. So that would be a test. And if that line breaks, then we should probably come down to 4,700. And that would probably provide support for a while, probably give another bounce. Everyone will think the stock market's doing okay, and then it rolls over again. And so the process goes on with recoveries, rallies, and each time making a lower low until probably 18 months from now, we hit the final low, maybe a couple of years from now, maybe late in 2027 or more probably 2028. Sorry, 2026 or 2027, and then take many years to claw our way back to the 6,500 level. And that's when the precious metals bull era would end. That's where the rotation then takes place back towards the stock market. So that kind of summarizes what the technical charts are saying there, Vladislav.
Yes, that's very interesting, Kevin. You answered a lot of my questions, so thank you very much for that. But yes, I'm fascinated with the technical analysis as well, because it's very interesting the way charts can predict future events before they actually occur. So while you do not know what's going to occur, you can expect by just looking at the chart that something's going to happen. And as you have said, if you stack these different indicators, that increases the chances of you being correct. So it's really, really interesting. Like, for example, right now, it would be wise to maybe tilt your portfolio towards gold if you don't want to go, all in, if you still want to get involved with the S&P. But even by just looking at the chart, it sort of tells you how you could tilt your portfolio based on the evidence that we have, which is very, very useful. So again, thanks for that, Kevin. And so my next question will be about portfolio structure in the current environment. So of course, there will be different opportunities like at any times, but what are the charts telling you about certain sectors that could be interesting in the current environment?
Yeah, okay. Well, I'll share my screen and we'll take a quick look at that. So the way to do that is once you've determined that we're in a precious metals bull era, and really that chart for the Dow Jones versus gold is the chart that tells you that we're in a precious metals bull era. I mean, after all, the stock market hasn't outperformed gold for 25 years. We had a period of outperformance, but overall, this century, since the year 2000 or even 1999, the stock market has not outperformed gold. In fact, if you just measure it from there to where we are now, the stock market has lost 71% compared to gold. So I think that might shock a lot of people that the Dow Jones has lost 71% versus gold since the year 2000. But that is a simple fact. So once you realize that you're in a precious metals bull era, what you do is you price everything in gold, not dollars. We know that dollars are being devalued. So why would we want to price the Dow Jones in dollars? I mean, this is it priced in gold, right? Remember that shape of the chart. It's been falling since the year 2000. Now, if I just put the Dow Jones here, DJIA, no, not that one. I'll try that again. There are so many different listings on. Let me just find the right Dow Jones Industrial Average. That's the one. So that's what the chart looks like if you price it in dollars. So that's the Dow Jones priced in dollars. So it looks great, doesn't it? Dow Jones is going up, priced in dollars, but priced in gold, as you saw, from the year 2000, which is way back off the left-hand side of this chart, it's been going down. So you just see if I can find the full chart for the Dow Jones, because I think I've got it here somewhere.
And it's very interesting, Kevin, if we look at gold and we look at the price of houses measured in gold, the prices didn't really change, because we all talk about, oh, the housing increased so much, it's so expensive. But in gold terms, it's pretty much the same like as we had in the 70s in US.
It is, yeah, it is. Here's the Dow Jones priced in dollars from the year 2000. So it went fairly flat for about 10 years. So that was the 2000 to 2012 period, where, as I said, the stock markets went absolutely nowhere in a series of, well, crashes, really. And then we accelerated upwards from 2013 to where we are now. So that chart looks very, very different to the one I just showed you if you price it in gold. And as you said, if you price houses in gold, USAHP is on here somewhere. I think I just went past it. USAHP, here we go. So this is house prices if you're paying for them in gold, if you buy your houses in gold, since 1975. So that's the price of a house in 1975. It was 222 ounces of gold, or 220 ounces of gold. Now, today, it's, well, actually, the current reading is 149 ounces of gold. So it's cheaper, a lot cheaper now to buy a house if you're paying for it in gold coins than it was in 1975. So if you were to look at the house price chart in dollars or pounds or euros, of course, it's just gone from bottom left to top right as the house prices go up and up and up and up and up. But gold protects your purchasing power. Yes, it goes up and down and up and down, but over long periods of time, it just gets back to where it started. And if you choose your time carefully, you can enter the gold market during a period when it's outperforming and make huge real-term gains. So yeah, a lot of people don't understand that pricing things in gold is a good idea. Now, just going back to your original question there about portfolios, for example, we know that in a precious metals bull era, the other commodities will have their chances to do well. And what I mean by that is silver particularly does well after the stock market has bottomed. So a year or two from now, silver will be soaring, assuming that the stock market has fallen significantly. So significantly is at least probably 30% or so. So when the stock market has had a large fall and then reaches its bear market lows, might be 18 months from now, that is when silver massively outperforms. Silver's a recovery metal. Gold will still be going up, but silver will be going up faster. So that's when you balance your portfolio towards silver and silver-related assets, silver miners and that kind of thing. Platinum is another one. This is a chart for platinum. You can see how platinum has broken out, moved up very strongly, and is now likely to be coming back for a consolidation, possibly even a back test somewhere around about $1,050 or so. But it's at $1,300 at the moment. The consolidation may not come back as low as that, but that was a very strong move and it needs to cool off for a while. But the important thing, as I said, price platinum in gold. So this is platinum priced in gold on the monthly time frame chart. So for me as an investor, I don't want to buy anything if it's not outperforming gold. All my assets are going to be in gold. The base assumption should be that your wealth is held in gold, not in US dollars, but in gold. So if you hold your wealth in gold in a gold bull era, then that's a good starting point. Let's say you've got $100,000. I'm going to assume in a precious metals bull era that you hold your $100,000 in gold. That's your starting point. And then from there, you would reallocate some of that capital into assets as they outperform gold. Now, at some point or another, platinum is going to start breaking out and it'll outperform gold. That's the time to own platinum, not now, because it's not outperforming gold. All it's done is it's had a little pop, hit the resistance line, just like it has done on previous occasions, and now it's moving back down again. So anyone who bought into that rally is probably losing money now because platinum is pulling back and underperforming gold once again. So a big part of being a trader or an investor is being patient, waiting for the evidence. Because if you jump the gun and you enter the platinum market before the evidence tells you to, you're quite likely to regret that. And you could have done that back in 2010, thinking we were breaking out and we didn't. Could have done that in 2014. You could have done it in 2021. All of those occasions, it would have been a total disaster to put your money in platinum because it plummeted versus gold. And platinum has lost 88% of its value priced in gold. Why would you touch that with a 10-foot pole? You wouldn't. Palladium is another one that people talk about a lot. Palladium has had a little upside move. I'll just get rid of some of these annotations so you can see what's going on. It's had a little upside bounce, but it hasn't broken out above the 3 or 4 year moving average, hasn't broken out above the Ichimoku cloud there. It hasn't done enough to put itself into a bullish environment yet. So Palladium is prone to pull back and further consolidation. Copper, well, we know about copper. The industrial metals, absolute disaster here. I mean, it was getting up towards $6, and now it's all the way back at $4.40. We had a drop of around about 30% in a day or two. In fact, in a few hours. So patience is important. Waiting for that weight of evidence, and that's why with our website members, we've been saying for a long time now to be cautious taking positions in the miners. We've only taken a small NAV risk position so far because this isn't the time yet. If you look at the miners, GDX, or let's have a look at ASA versus gold now, or ASA versus the stock market. ASA is a precious metals mining index that matches the GDX chart, and it goes back about 50 years, so it's got more data. Now, all of this that's going on the chart down at the bottom here is just a consolidation. It's building a base ready to break out above that breakout line. And the moment it goes above that breakout line, yep, I'm all in because that's when the bull market is born. Look at silver junior miners versus the stock market. They haven't broken out yet. This is one massive downtrend for silver junior miners versus the stock market. As soon as it starts breaking out above this red horizontal resistance line, above these two red resistance lines, above the green 4-year moving average there, and particularly when we get above the Ichimoku cloud here, that's when you want to be all in on silver junior miners. That's when the trend is changing and you can make a lot of money very quickly. Look how quickly it can move. This is just 1, 2, 3, 4, 5, 6 months and the move is finished. Well, that was in 2016. I suspect, because that wasn't a massive bull era, what I suspect is that this is going to move up much further, much longer for a few years and reach much higher highs. So we can price anything in gold. You can look at the uranium miners priced in gold. Uranium gets quite a lot of coverage. And look, all it's done so far is it's broken out. We had a nice rally in the uranium miners, which we participated in back in 2021, 2022. But since then, they've kind of gone sideways versus gold. In fact, at one point, there was a huge breakdown, and we're just recovering from that now. On this ratio chart, it's very clear that you need to pass through this zone here, where we've got the red circle and the horizontal resistance zone. You pass through that, and then the uranium miners are in a massive up leg versus gold that could very well see it outperforming gold by 400%. So that's when I would be saying, yeah, the evidence is fully there to take significant positions in the uranium miners. for the time being, at this early stage, gold and or silver are adequate. You can make good money in gold. The last 18 months, you've doubled your money in dollar terms. You've increased your US dollars by 100%. And that's enough. We can be sort of satisfied with that until these ratio charts break out. And once they do, there'll be huge profits to be made. And that's how you adjust your portfolio in a precious metals bull era.
Thank you very much for that, Kevin. I think we covered a lot. So we have very little time left, Kevin. Before we finish up, I like to ask this question. For a person who's new to this, to technical analysis, to investing, maybe this individual has a lot of choices: the stock market, the Bitcoins, the Teslas, the things that we're talking about, commodities. What advice would you have for that person who's still at the beginning of their wealth building path or studying about technical analysis or investing? What advice would you have, maybe on how to start, what to look at?
I think you've got to understand in your own head whether you're a trader or an investor, Vladyslav. Are you looking to trade, or are you looking to invest for the long term? And if you're quite young, in your 20s, for example, you'll get one or two cycles like this where stock markets outperform gold or gold outperforms stock markets. Now, my advice would be to be aware of where we are in that cycle, because if you invest at the wrong point in stock markets, and I suspect this is going to prove to be one of those wrong points, then you're going to be starting with a massive disadvantage, because you could put $100,000 or even put $10,000 into the stock market. You could see that turn into $6,000 over the course of 18 months, and that would be quite a big loss for someone starting out. So spreading your risk management, being aware of whether you're a trader or an investor is important. I mean, the stock markets will and have proven over the decades to always recover their losses and keep moving up. And that's primarily because the unit of currency that we're valuing the stock market in is continually depreciating. The stock market over long periods of time outperforms precious metals, and it gives you a return with dividends as well. So broadly speaking, the stock markets are a very good bet. But for certain periods of time that last, in excess of 5 years and often as much as 10 years, gold is the better bet. And even taking dividends into account, gold and precious metals related assets will see you having bigger returns. So just be sure in your own mind: are you trading, are you investing, and where are you in that economic cycle? Because that's going to make a big difference to your likelihood, your probabilities of being successful.
Thank you very much, Kevin. Kevin, I really enjoyed the conversation. Thank you very much for being here, and I hope to have you back.
Okay, Vladyslav, it's been good being here. Thank you very much.